Class is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to James Cooper Creston's budget, well, it should say webinar, but we presented it as a seminar this morning, so we're rehashing the slides and using them again. And you can see that we've also kind of dusted off what we were expecting to do for 2019, when, of course, the budget was actually cancelled, so it becomes the budget of 2020. So just to introduce myself, first of all, Alex Nicholson, I'm a business tax partner with the firm. I'm going to cover off, not unsurprisingly, the sort of business tax measures that were announced in the budget. I'm then going to hand over to my colleague Ian Miles, who sat beside me, and he's going to cover off personal tax matters. So without further ado, I suppose we'll dive straight into it. It was kind of two budgets in one, really, in the sense that we had the sort of normal stuff that we might expect in a budget, but of course, in response to the coronavirus, there was very much a whole package of measures and things that were introduced to help ease individuals, businesses, etc., that are going to be affected by the virus. I'm not going to dwell on it too much, but of course, just really to say that it was a budget of two halves. And of course, yesterday we also saw the Bank of England do an emergency base rate cut to 0.25%. Just some figures up there on the slide, really, just to sort of talk about what's happened to the FTSE, which of course back as recently as the 17th of January was sitting at over, well, nearly 7,700 points. As at last night, it closed at 5,876. Of course, there's drops in the stock market around the world, really, but it just does go to show the extent of the concern, really, that's out there in the markets. So as I mentioned, budget vaccination, really, against the coronavirus. I'm not going to go through all those measures. I think a lot of it has been widely sort of talked about in the press now, but there are a whole raft of measures that the government's introduced to help the coronavirus. I will pick up on one or two of those a little bit further on in my talk. So just on the current state of the UK economy, well, growth forecasts, not unsurprisingly, I suppose, have been downgraded from March 2019. However, the Chancellor did stress that this is without the impact of the coronavirus. So actually, we may see a further downgrading, at least in the short term, in due course. So you can see really that growth this year was forecast to be 1.4. That's been downgraded to 1.1. So across the board, really, the growth figures are lower than was previously being forecast. Borrowing against GDP as well, that's the sort of percentage. I think that's still sort of broadly on track, but it has come down from where it was. But overall, we did see a big spending spree announced yesterday. And we kind of noticed when we looked at some of the detail that actually public debt is set to exceed 2 trillion at some point in the not too distant future. So overall, it doesn't feel like a traditional sort of blue government budget because there's a lot of spending. And it does feel like a real end to austerity. So getting then into the tax detail of some of it. So really, measures for businesses I'm going to cover off now. So the main rate of corporation tax, just starting with that, it's currently 19%. It was planned to reduce to 17% in April 2020. That's been scrapped. We knew about that before yesterday. That's forecast to raise 4.6 billion for the government in 2021 and 6 billion in 21-22. Going back just briefly to the coronavirus, the improved time to pay measures were announced yesterday. So back at the time of the last sort of recession in 2008, the government was very keen to do what it could to help businesses that were struggling by giving them a little bit longer to pay their tax bills. And we've been told yesterday that they're going to sort of ramp up that service again in response to the coronavirus. So there's going to be a dedicated helpline, but I think more widely you'll see the revenue being more receptive to allowing businesses time to pay their tax. The key there really is to try and contact them in advance, i.e. before you've gone overdue on payments. The government's also announced that it's going to try and improve funding for affected businesses, which is going to be done through the banks, but effectively with the government providing a guarantee for 80% of the loans that may be offered. Of course, big news really yesterday for many businesses was the 1-year holiday from business rates. And actually that's going to apply apparently to 45% of all sort of rated properties within the UK, and a wider review has been announced. Capital allowances, just a reminder then, where a business charges depreciation in its accounts on its capital assets, that's not normally allowable for tax purposes, and instead tax relief is given through a system of capital allowances. No major changes were announced yesterday, and what typically happens is that assets go into one of two pools, where they either attract an 18% writing down allowance on a reducing balance basis, or just a 6% allowance on a reducing balance basis. Now you can see that at 6% in particular, it takes a very, very long time to get tax relief for the perhaps plant and machinery, cars, etc., that have gone into that pool. So the important point really is that actually, all businesses have available to them an annual investment allowance, which allows them to write off up to 100% of qualifying costs. And that's currently set at a limit of £1 million until March 2021, which is an increase from the sort of standard level of 200,000. The message there then is you've got effectively another year, if you've got significant capex planned that would qualify for capital allowances, to sort of maximise your reliefs under that annual investment allowance. One change we did see was to the structures and buildings allowance. So this is a new allowance that was introduced a year ago. Well, I say a year ago, of course we didn't actually have a budget last year, so in late 2018 it was introduced. And this gives a measure of relief for businesses that are acquiring or constructing properties for use in their trade, and they're going to be able to sort of write off the cost of those properties. So it was going to be over at 2% writing down allowance on a straight line basis, and that's been increased to 3%. What that means in practical terms is that you'll now get relief over a 33-year period for qualifying spend instead of 50 years. So still going to take a long time to get relief, but actually we're talking about some quite significant sums of money that will attract this. So that will be welcomed by many, I'm sure. Just a reminder that there's no relief on the actual cost of the land itself, and it also doesn't apply to residential dwellings. So I'm going to spend a little bit of time now talking about company cars, by which I mean really employer-provided vehicles. So if you're an employee or a company director and your employer provides you with a company car, that's what we're talking about. In particular, I'm going to talk about zero-emission vehicles. I, for one, have seen an awful lot of the cars in the slide on the roads recently. So that's the Tesla Model 3 that was launched last year. It's a sort of what might be termed a reasonably priced electric car, has a sensible range, lots of good green credentials, and has so far obviously appealed to many given the number that seems to be on the road. It also makes sense as a company car, and that's about to get even better, and that's what I just wanted to pick up on. So what we're going to see from from April of this year, is that the benefit in kind that an individual who receives this car as a company car that's available for private use suffers is going to be set at 0%. In other words, the recipient of that car is not going to have any tax to pay on the receipt of that company car benefit. In the following tax year, it's going to go up to 1%, and the year after, just 2%. So these really are historically low levels of tax to drive people to, no pun intended, but to push people towards taking an electric car as a company car. So I've just put up on there the figures really for the Tesla, which has a list price of around about £42,000. So okay, it's not a cheap car, but it is within the range of many sorts of company car drivers. But as you can see, tax for a 40% taxpayer with the receipt of that benefit is zero in the next tax year, a mere £14 a month in 21-22, and then just £28 a month in 22-23. So really, really some generous tax breaks there for the next 3 tax years. But just a word about PHEVs, which of course are hybrid cars, so they tend to have a smaller electric range, and couple that with typically a petrol engine of a certain size. They will make sense for many, because I think there is still a nervousness around electric cars, their range, will I be able to charge them? And if you've got your sales reps and things that might be racking up big miles, they don't necessarily quite make sense just yet. But I just wanted to show really the tax benefit that now exists for a PHEV, really compared to your traditional company car, which might be sort of a 2 litre sort of diesel car. So I've got here an example of the BMW 330e, which has a 37-mile electric range, and then it also has, I think, a 2 litre petrol engine. So the benefit in kind on that for each of the next 3 years is going to be calculated at 10%, then 11%, and then 12%. But that compares to 31% for the equivalent 2 litre diesel car. So you can see that there's some very, effectively the tax on that by having the PHEV is going to be about a third of the tax on the diesel car. So again, that really sort of makes sense, and we're really starting to see businesses driving buying decisions based on this. And one of my clients has just bought 77 PHEVs, so the numbers are big for them. Moving on. Finally, then on company cars, just quickly to sort of demonstrate the extent of the generosity of this relief. Apparently, Bill Gates has just bought one of these. It's a Porsche Taycan, which is effectively a supercar. It's got a list price of £136,000 for the basic car. And the tax figures there for a 45% taxpayer, basically zero in 2020-21, and then very modest amounts through for the whole of the next 3 years. After that, we will see, I think, electric vehicles return back to more normal sort of benefit in kind levels, probably closer to those for the PHEVs. So it is the government, using tax legislation to drive the change in behaviour, but a really good opportunity for many at the moment. Just finally on that, before I do move on, there's a range of other benefits that come for a business which is choosing these zero emission vehicles, or indeed very low emission sort of vehicles. They're going to be road tax exempt through to 2025. There's minimal employers NIC on the benefit in kind, because of course it's a minimal benefit. Actually, if they're buying these cars, they can get 100% first year allowance for capital allowances purposes through until 2025. Also, a fully electric vehicle, to the extent that it's used for business, 4 pence per mile can be claimed, and free workplace charging is also available. So really, really tax efficient for the next 3 years. As ever, the government's very keen to encourage R&D and plans to raise public R&D investment to 22 billion by 24-25, which actually represents 0.8% of GDP. And the total investment there that they're targeting by 2027 is 2.4% of GDP. So we saw a number of sort of measures that were announced yesterday. There's various ones up on the slide there. I don't want to dwell on them too much. There were a couple that I would mention is that locally, 180 million of funding is to be made available for a state-of-the-art storage and research facility at Harwell, which is just up the road from where we sit in Newbury as we present this. And £200 million to the British Business Bank for taking equity effectively in life science companies. And we actually act for an awful lot of different life science companies, particularly out of our Oxford office, so this is welcome news. I think what we're really seeing here actually is the government looking to replace a whole load of EU funding that has dried up for some of these companies, so clearly welcome news. Picking up on R&D tax credits, so sticking with the R&D, the government, of course, provides generous tax release for companies undertaking R&D activity. This is only companies, it's not available to unincorporated businesses. There's two schemes. There's the SME scheme, which is quite generous, well, particularly generous, and then there's the RDEC scheme, which typically applies to larger companies. But having said that, we also see a lot of our SME clients claiming under the RDEC to the extent that they have R&D activity which is grant funded or otherwise subsidised. So one announcement that did come out yesterday was the RDEC rate is going to increase from 12 to 13% from April 2020. What that means in practice is that the actual effective relief is going to become 10.5% roughly of the actual eligible costs incurred. So in essence, that's the sort of tax saving that you achieve. There were no changes announced to the SME scheme, so the headline rates remain the same for that. But we do wonder if we might see further changes in the next budget, or at least next year. And that's because the SME scheme is far more generous in terms of the relief it provides, and it's a notified state aid, so currently it has to be it's sort of bound by EU rules. Next year, obviously, we should be free of that. One welcome thing for many of our clients is that the payable tax credit for companies that have a loss, so companies that have a loss can surrender effectively their R&D losses to the revenue in return for a payable credit. It has been proposed, and it still is proposed, that that will be limited to 3 times the company's total PAYE and NIC contributions in the period. That was due to come in April this year. It's been pushed back to April 2021. And indeed, there's going to be sort of further consultation on its implementation. We had a number of clients that this might have had quite a serious impact for, so we're very pleased to see that. And indeed, we've actively engaged with the revenue over the issue. Finally, on R&D, there's going to be a consultation on including cloud and data costs within the categories of eligible expenditure for which the relief can be claimed. Currently, those costs can't be included. And for software as a service, for example, companies, we often see that they incur significant sort of hosting costs, which does relate to their R&D, but currently it can't go into their R&D tax credit claims. So it would be good to see some positive news around that in due course and a widening of the relief. Entrepreneurs relief. As was widely announced in advance, really, changes to entrepreneurs relief have been made. The relief has, however, been retained, but what has happened is it's been massively scrolled back. So actually, it's going to be back to where it started. So as a reminder, entrepreneurs relief provides a tax rate of just 10%, or a maximum tax rate of 10% on qualifying gains. And up until yesterday, every individual had a lifetime limit of £10 million to which they could claim that relief. That's been scrolled back to £1 million, which, as I said, is roughly where it was when I think it's exactly where it was when it first came in. Surprisingly, that's actually effective as of budget day yesterday. We thought it was more likely to apply from the 6th of April coming. But anyway, it's there, it's with us already. But that's not to say that, entrepreneurs relief is no longer valuable. The maximum benefit is now £100,000 in terms of tax savings, so it's still worthwhile. Various anti-forestalling measures have been introduced to stop anybody that's tried to sort of do some aggressive planning around it in the last few months, knowing that the relief was likely to be scaled back. But the reason there's a set of scales on the slide there really is just because I wanted to make the point that actually it's still very attractive really to entrepreneurs to make a capital disposal of an asset, because the main rate of CGT is only 20%. And that's very attractive compared to a top rate of income tax of currently 45%. It will, of course, become increasingly important to maximise the family benefit that can then be obtained by ER. Currently, where we had the £10 million lifetime limit, many individuals felt that they wouldn't reach that, and therefore, it wasn't of much of a concern to them. But of course, now with it being 1 million, you might look at whether it can also be made available to family members who sort of work in the business. So we don't know what the future will hold, but entrepreneurs relief is still with us and is still worthwhile planning for. And the final bit I just wanted to mention on that slide really is that there's also another relief called investors relief, which has been retained and which is not sort of widely talked about in the same way that entrepreneurs relief is. But effectively, it also provides a 10% CGT rate, and it can apply on gains of up to £10 million. The difference really is it's aimed at investors in companies rather than those who kind of work in the business. And so generally you can't be an employee, although there are various business angels rules that do apply. So actually, I think we're going to start to see people looking at whether they can get into the investors relief provisions more widely going forward. Quickly then through national insurance contributions, no changes to rates, an increase in the threshold, so class 1, which is paid by employees and employers, will now only kick in for individuals earning more than £9,500 in a tax year. The rates have been similarly changed for class 4, so that's welcome news for those and takes a number of people out of paying national insurance altogether. No change, however, to the upper earnings limit, which stays at 50,000. Smaller businesses, and that's businesses with a total national insurance bill of under £100,000 per tax year, can qualify from the employment allowance, which basically just reduces the amount of employers' NICs that they have to pay. That's gone up from £3,000 to £4,000, so welcome news for those businesses. No abolition of Class 2 NICs, which is also paid by the self-employed. We've been promised sort of changes around, or expecting changes around that for a long time, but it hasn't happened yet. And there's a 1-year national insurance holiday for employers of veterans. Just wanted to briefly mention the off-payroll workers rules. There were no new announcements around this yesterday, but these do come in now from April 2020. We've been talking about them some time, and businesses that are affected, if they haven't already, really do need to consider these new rules. So in a contrast to what was originally announced, back when we were first told about the forthcoming legislation, these rules are only going to apply to medium and large companies, which is those meeting any 2 of 3 criteria, which is 10.2 million turnover, total assets of 5.1 billion, or having over 50 employees. For unincorporated business, it's a simplified test which basically just looks at turnover. So if you have a business that ticks those boxes, i.e. it is a medium or large business, and you are using contractors, off-payroll workers, you do need to consider these new rules as a matter of priority. That said, there is going to be a soft landing in the first year, and there's not going to be any penalties imposed for failure to comply. So just to try and illustrate really what these rules mean in practice, the slide here is effectively kind of trying to demonstrate the contractual relationships that exist. So on the right-hand side of the slide, we have the worker, and on the left-hand side of the slide, we have the end client for whom they're performing services. So very often then there'll be a whole chain of sort of bodies and things in there. So the worker, for example, will often have their own personal service company, their own limited company through which they provide their services, perhaps to an agency who then onward provides them to the end client. So what these rules require is that the end client needs to make an assessment as to whether the worker at the far end should be treated as an employee and taxed as an employee. And that's a big shift from the previous position where really the end client didn't have to get too concerned about it. So the end client's going to have to make those determinations, and failure to comply could be very costly, really. So do think about those rules if you haven't and might be caught. We're told there's going to be a review of EMI schemes. We don't know any detail on that yet, but that's a tax advantage share scheme used by many SME businesses to attract and retain talent. Hopefully that's just about targeting it and making sure it's being used in the best way. Plastic packaging tax is going to come in as the government seeks to not necessarily remove plastic packaging altogether, but to make it more recyclable, and then to have more recycled content. Otherwise, it's going to be taxed higher. I won't talk about the tax rules for non-resident companies because I'm mindful of time, but just to be aware that there are some changes if you're a property company and you're non-resident that come into effect from April this year. The revenue are going to get lots of additional staff to tackle avoidance and collect debts. I think they've 1,300 staff to tasked with collecting an additional sort of £4 billion a year. So moving on, just want to spend a few minutes talking about some VAT changes. No changes to the primary sort of registration and deregistration thresholds. Good news in the respect of e-publications, so that's audiobooks, sorry, not audiobooks, but books on screen, magazines on screen, all that type of stuff are going to be zero rated for VAT with effect from December 2020. So that brings it in line with paper publications, and it will be a welcome change, especially as we move to more and more e-publications. As I said, though, that won't apply to audiobooks. So just a brief mention about postponed accounting for import VAT, which will begin from the 1st of January 2021. So the end of the transition period will effectively see the end of the reverse charge provisions that currently apply within the EU, but it will also apply to non-EU transactions as well. But basically, these mean that when you import into the UK, businesses won't have to pay import VAT at the point of bringing goods, etc., into the UK. and will need to account for both the input and the output of that in their tax return, and will benefit them from a cash flow perspective. The tampon tax has gone. Nothing more much to be said about that. Good news, I'm sure. And then finally, the VAT domestic reverse charge for building and construction services starts on the 1st of October 2020. So if you are in receipt of building and construction services, for example, if you're within the construction industry scheme, you will need to be applying these rules. It's to help prevent fraud, and you do need to take advice if you haven't already to ensure that you're prepared for the changes that come in on the 1st of October 2020. We've got some ongoing VAT consultations. Nothing much to say about that at the moment because we're still awaiting a response, but we're hoping to see some simplification to the complex partial exemption and capital goods schemes rules that currently exist. Finally, from me then, I just wanted to pick up on some duty changes. So we have a former Chancellor of the Exchequer there, Ken Clark, with his glass of whiskey. He'll be very happy because duty rates have been frozen on all alcohol for the next year. Fuel duties frozen for the 10th year in a row. No significant changes to air passenger duty. It sort of kind of goes without saying that if you're a smoker, you haven't been accepted from all these duty rises, and 27p on a packet of cigarettes. Some significant changes to red diesel, with the subsidies being scrapped for many sectors, most sectors really. However, there are some exclusions from that, most notably agriculture and fishing. So that's quite a significant change for some businesses, which will, have to effectively pay more for their diesel going forward, i.e. with the duty of normal diesel. I think that's probably all I want to say on duty changes for now. So I think without further ado, I shall hand over to Ian.
Thanks, Alex. Good afternoon, everyone, and welcome to this afternoon's webinar from me. Okay, so I'm going to talk over the course of the next few minutes about tax changes that did or didn't come in yesterday. So let us start with income tax rates and allowances. And you can see there that all of the personal allowances and the rate bands are exactly the same as they were last year. The reason for that was that last year, Philip Hammond, who was the Chancellor then, had got to the government's target 1 year early, and he announced at that point that those would be the same limits and rates in 2021 as they were in 1920. The point about that slide is not only they haven't changed, but every year we've been used to a Chancellor saying, and actually I'm going to go further than I said I was going to go. Well, this year they haven't, and we're expecting future rises to be in line with the CPI. So what does that actually mean? Well, those who've listened to me before will know that I've said that as you increase the personal allowance to help those at the lower end of the pay scale, that what it means for those who have income of over £100,000 is that where they start to lose their personal allowance, they lose £1 of personal allowance for every £2 of income. That in effect means that you get taxed at 60% in that marginal rate. So that marginal rate gets wider and wider every time the personal allowance goes up. So this year there will be no change to that, and that costs an additional, effectively, £15,000. There are no changes in the rates at 20, 40 and 45%. Dividend rates remain the same, so that on the face of it, for the end user, it's cheaper to have a dividend from your company than it is to have salary. There's no change to the additional rate tax threshold at 150,000, and indeed there's no change to the starting rate for savings, which is 0% on the first £5,000 of savings income. So in terms of capital gains tax, the annual exemption rises in line with the Consumer Prices Index from 12,000 to 12,300. No change in the headline rate, 10 and 20%. Trustees of most trusts get 1/2 an annual exemption that an individual does. Residential property, which doesn't qualify for the main residence reliefs, is still taxed at 28%. And those who listened to me last time will remember that I said there were changes to capital gains tax on the non-PPR exempt property coming in from this April, 6th of April, and those gains now have to be reported within 30 days of completion. One thing that did change was pensions tax relief. And the Chancellor framed this very much as wanting to get round the position where some of the medical profession was saying, I'm not conducting additional procedures because it's not worth me doing so. And so he's put the lifetime allowance limit up from 1.055 million to 1.0731. The annual allowance limit, the total cap, remains at 40,000. The tapered annual allowance drops from 10,000 to 4,000. But you're only subject to that taper if you hit both triggers. One is that your adjusted income, so that is your income including all pension contributions, whether you've made them yourself or whether your employer has made them on your behalf, which was 150,000, that now goes up by 90,000 to 240. And the threshold income, so that is your income after deducting the contributions that you've made, goes up from 110,000 to 200. The final number on that is the money purchase annual allowance, which hasn't changed. That's if you're in receipt of a pension, you can only put £4,000 back into top it up annually. So as an example, if you had £150,000 of adjusted income, in the 1920 tax year, you could make a contribution of £40,000. For every £2, just like losing your personal allowance, for every £2 of income you have in excess of that, then you lose £1 of allowed contribution. So by the time you get to £210,000 of adjusted income, you're at £10,000. For every pound you get more than that, it still sticks at 10,000. So the proposed rules for 2020-21 are shown below. And what the Chancellor said was, I'm going to increase the 150,000 limit of adjusted income to 240,000. And you'll still be able to make your £40,000 contribution. Nobody will be disadvantaged compared with this tax year, provided their income does not exceed 300,000. So if your income is 300,000, then your relief will get tapered to 10,000. But if you look at that slide then below, by the time you've got up to 312,000 of income, you are stuck with a contribution of 4,000. So that's good news and bad news. Good news for those who earn in excess of 150,000 or 240, because they can still continue to make full contributions. If you are in between 240 and 300, you'll be no worse off. But for anybody who earns over 312,000, then you'll be limited to £4,000 of contribution that you can make and get tax relief on. Okay, just one quick change. It came in, was announced last year, comes in from this April, on the private residence relief. The final period of exemption, so if a house has ever been your main residence, originally you used to be able to have 3 years, the last 3 years were exempt. That was then reduced to 18 months. And from the 6th of April this year, it gets reduced to 9 months. There are no changes to the 36-month rule for those who are disabled or for those in a care home. And finally, I think it was billed by most people as the end of lettings relief, because it will only apply from this April onwards, where the owner of a property is in shared occupancy with a tenant. Okay, I'm going to talk about possible inheritance tax changes in a few minutes, but in terms of this year's budget, there were no changes to inheritance tax. The nil rate band is still 325,000. The residence nil rate band goes up to 175,000 from the 6th of April this year. That will then mean that an individual who's got a house has got £500,000 of tax-free nil rate band in effect, or for a married couple it's £1 million. So there are tapering reliefs once, or there are tapers rather that come into play once the individual's income is or assets are over 2 million. But that got the government's target of saying we'll give tax relief on the first £1 million. The ISAs might look a little bit strange, but on thinking about it, it was perhaps 2 or 3 years ago, I think George Osborne put them up from 15,000 something to £20,000 at one fell swoop. I think it was the year that he brought the pensions cap in at 40,000. And so junior ISAs and child trust funds would go up quite a bit to 9,000. Maybe that's just to catch up. Now, on for a little bit of speculation perhaps. There have been two inheritance tax reports that have come out in the last year. The first one came from the Office of Tax Simplification in July last year, and that was simplifying inheritance tax. The second one came out in January this year from the All-Party Parliamentary Group, and that's really a bit of a rebuild from the ground upwards, and it's quite different. They're proposals, but I really just want to use them to illustrate the direction of travel. So if people are thinking of doing inheritance tax planning, they might wish to look at those rules and decide whether they want to do it under the current relatively benign regime or wait and see. So this is quite a busy slide, but the Office of Tax Simplification came up with 11 recommendations, which I'm going to cherry pick from this slide. So they said, let's replace the annual exemption, the annual gift exemption, gifts in contemplation of marriage, normal expenditure and so on, and a small gift exemption, just with one annual allowance. We'll reduce the 7-year survivorship period for a pet or charitable transfer from 7 to 5 years and abolish taper relief, because most people survive 3 years and the tapered relief doesn't collect very much tax. If you made a gift 7 years ago and then made another one today, you might have to look back 14 years to work out how much you'd got on your nil rate band. And that's too difficult for people to keep records, so I'm going to get rid of that one. The next bullet point I want to just discuss briefly is the one about abolishing the CGT uplift on death unless IHT is paid. So if I was to die leaving all of my assets to my wife, then the assets would be revalued to market value for capital gains tax purposes on my death. No IHT would be paid because it would be spouse exempt, and she could then make gifts to other people, to other family members, etc., out of those gifts and pay no CGT. So it would be a very easy one to do, to say we're only going to allow you the CGT uplift if inheritance tax is actually paid. The next one is a real point that's been talked about for some time. So for business property relief and agricultural property relief, there's a wholly or mainly test. Are you wholly or mainly trading? Whereas for capital gains tax relief, for holdover or for entrepreneurs relief, then the wholly or mainly test is set at 80%. And people have often said, well, why is there are two different thresholds? Or should we not make IHT in line with CGT? And in addition, furnished holiday lettings are treated as a trade for income and capital gains tax purposes, but not for IHT. And the recommendation is that they should get the IHT exemption as well. Farmhouses in sensitive cases, there have been a couple of cases of farmers who've had to go into nursing homes and have then been denied agricultural property relief on the farmhouse because they weren't occupying it for the purposes of agriculture for the last 2 years of their lives. And the final one I just really want to pick up there is pre-owned asset tax. It was brought in for a reason to counteract some inheritance tax schemes that were designed to get round the gift reservation rules, and the recommendation is to review the rules to see if they're effective and whether they are really necessary. They're certainly complex to understand and to apply. So I come to my final slide, which is simplifying the design of inheritance tax. And this came out by the All-Party Parliamentary Group. And they made two recommendations. I really want to focus on recommendation 1. The first is that the current IHT regime is scrapped and that there is a tax on lifetime and death transfers of wealth. There are very few reliefs, so agricultural property relief and business property relief would go. And that, I think, would be a seismic change for the owners of businesses and for farmers in this country, and would probably make quite a significant difference. However, there is a low flat rate of somewhere between 10 and 20%, but even in the case of farms, for example, I suspect people would have to sell things in order to be able to pay the tax, and that the CGT uplift on death would be abolished. So never mind whether inheritance tax is paid or not, or whatever the new tax would be called, the CGT uplift would be abolished. Whether that would cause difficulties with record keeping, who knows? The final two bullet points I want to have a look at are that the nil rate band is available on death only. So at the moment you can create a trust every 7 years, for example, and use a new nil rate band every 7 years. That would not be the case. You would only have one nil rate band, which would be utilisable on death and not on any other occasion. The counter to that is that actually everybody would have an annual gifts allowance of something in the order of £30,000. So you can make £30,000 worth of gifts. So over 10 years, you could still give away 300,000 if you wanted to. And then on top of that, there's a flat rate tax of, say, 10%. So that brings me to the end of speculation. Those two are recommendations at the moment. Whether they will come into play in a later budget, perhaps later this year or next year, we have to wait and see. So finally, let's just have a very quick look at who the winners are. So drivers, so we're going to get £2.5 billion to fill in the 50 million potholes, or potholes, as the Chancellor said yesterday. Always an emotive subject. Rough sleepers, 643 million for general support, training, substance misuse, recovery and new accommodation. Those who've been subject to flooding, the rural communities and broadband, I think 90% of the country to have decent broadband. The Nature for Climate Fund for peatland and bog restoration and tree planting. Those living in tower blocks with cladding. And last of all, but not least, public lavatories business rates are going to get some relief. So that brings us to the end of today's webinar. I hope you've enjoyed it and I hope you've learned something. So I was going to say it's goodbye from me.
Oh, well, actually, I was just going to pick up on a couple of questions very, very quickly that we've had come in. The first question is a very good one, actually, which is asking whether disposals to employee ownership trusts, which will still be exempt from CGT. I haven't seen any changes around that announced, so my assumption is that yes, that's still an option in the right circumstance. Second question there that I can see is it just says sort of EMI scheme. Question mark. If anyone's sat out there and they don't know what an EMI scheme is and they'd like to understand it more, then please feel free to contact us. We're very happy to talk about it. But basically, it is a tax advantage share scheme that's specifically aimed at SME type businesses to attract and retain key staff, and it offers some generous tax breaks to them on a disposal. Very, very good at sort of retaining people where there's a grow and sort of sell strategy that's proposed. I can't actually quite read any more questions, so I think that's probably it, and we'll bring it to a close. So it's now goodbye from me as well. Thank you.